I have a dream, that's all I need. I'll make it happen with some work and belief. Know what I want, so I'll take it on. I've made mistakes, but mistakes make you strong.
Hi there, I'm JB. I must warn you, this video will make you paranoid and question a lot of stuff. When I researched for this video, I had no idea how much money you and I actually risk losing. And even though we thought we had the simple strategy and were just investing in the cheap ETFs like SPY and such, we're still doing it wrong and we're not even understanding this. So let's get on with it and see how we can avoid that. As the title says, fees will actually kill a portfolio, or at least take away as much as 67% of your gains, maybe even more. Yes, I said it, 67%, and trust me, I didn't believe it either. But then I went down the rabbit hole and wow, just wow. It's a lot of money the different entities take away from us, even the simple index funds or ETFs. So what do I mean? Well, let's start with the basics. We all know and hopefully understand the power of compounding. And guess what? The fees and expenses, they compound too. So what? It's just an extra 1%. It doesn't sound like much, does it? You will be very surprised to see how much that will amount to over a long time. Just 1 single percent.
Brandon, here's the deal. I want you to make an investment with me. Here's how it's going to work. I want you to give me your money. You're going to put up all the money. You're going to take all the risks. If it loses money, if it loses everything, you lose everything.
There's no consequence here.
Yeah, no. You put up all the money, take all the risk, you take all the losses. But if you make money, and even if you don't make money, I get paid.
Right.
And I get, over the course of your lifetime of investing, 30, 40 years, I'm going to take 60%. Would you make that deal?
Nobody would. But they don't know that they are all day long. You
That's
know
right. That is what you do with the average mutual fund today.
Yeah.
Because the average mutual fund with Forbes is 3.1%. If you're in a 401k, instead of saving money, many times when you add all the other fees, according to Forbes, it's 4.1%. What that does to your ability to ever get financially free is it basically decimates it. And how's that possible? Jack Bogle, the head of Vanguard, taught me this. He said, Tony, watch. Because people don't know. They don't do the math. For every 1% you give away over the course of your lifetime, that's approximately 20% of your total take.
For argument's sake, let's look at a typical fund investor. Let's say you invest $100,000 and get an 8% return every year, and you do this for 30 years. If that was possible without any fees or expenses, you would end up with a little over 1 million. Actually, $1,006,265.
$1 million.
Let's say you found an ETF fund or something with only an annual fee of 0.15%. Well, this original 100,000 would now be $965,179, meaning the cost of this simple 0.15% was $41,000. That's a bit over 4% that you will have lost in the end. Now, here comes the important part. Let's say that fund had fees and or expenses amounting to just that extra 1%, so around 1.15%, just 1 extra percent per year. How much would you think that would become over 30 years? Well, that would be a whopping $276,000. That's 27.46% down the drain. Let's take that again. That's almost 1/3 of your entire amount is eaten away with fees and expenses at only 1.15%. Shit. What would happen if the expenses and or fees were 2%? Can you guess it? Yes, that would be an astounding $430,000. You will never see that money and you will end up with only $574,000 instead of that almost 1 million. That's almost 43% of your money gone. Yes, really, that's crazy. And we haven't even talked about all the other hidden fees and expenses you probably never even heard about. That's why it's very, very important to find the best possible investment vehicle that both has great returns, but also has the absolute lowest fees and expenses. This is why I simply love Jack Bogle's approach and his Vanguard funds. His whole idea was to help the individual investor and letting us keep as much of our money as possible. In 2004, Vanguard Group estimated that mutual fund costs ranged around 2.5 to 3%, more than we just did our calculations with. At around the same time, Forbes put the after-tax total cost of mutual fund fees at around 4%. But wait, there's more.
But wait, there's more.
Let's do another example, and this one will really blow your mind. Just to show you that even the cheap ETFs can also decimate your results if you pick the wrong one, even if their expense ratios seem low at the beginning. Let's say, for argument's sake, we start with $10,000. We still expect the 8% annual return. And for fun, let's say for 40 years. Now let's add a monthly contribution of $300. We use Vanguard's VOO ETF, which is a low-cost S&P 500 ETF. The expense ratio is 0.03%, and as you can see here, there are only two expenses, the management fee and others, which is marketing and stuff, giving us a total of 0.03% in expenses. As the competition, we use the popular State Street Spider ETF, ticker symbol SPY, SPY. SPY also tracks the S&P 500 and is very popular among retail investors. But very few realize that SPY is 3 times more expensive than VOO, and they don't give you the exact expense fee, only that it can vary over time. But let's see the simple calculation. The original $10,000, the annual $3,600 in contribution, would have compounded into $1,140,000 using Vanguard's VOO, but only $1,120,000 if you used SPY. That's $20,000 in difference. They just disappeared because you chose the popular ETF. Don't use SPY, okay? The whole reason Jack Bogle started Vanguard and the low-cost index funds was because of these fees, and the way banks and mutual funds, etc., ripped off the retail investors, and there are a lot of other expenses normal investors don't even know about. In a typically managed mutual fund, they will often have the expense ratio, which is simple to look at, and sometimes an embedded 12b1 fee. They have loads, they have transaction costs, they have cash drag, taxes, advisor fees. So what are all these? Well, all funds have an expense ratio. This is usually published in the prospectus. Easy to see, easy to find. The expense ratio generates money to pay the fund, salaries, compliance, legal, travel, etc. This one is pretty simple. But some funds also charge a 12b-1 fee, which is used to market the fund. Hey, wait a minute. That means you as an investor, you pay to market the fund to other investors? What? Then we have the so-called load. It's a one-time commission for buying shares in the fund. This can both be a front-end load or a back-end load, meaning you either pay at the time you purchase, front-end, or when you leave the fund, back-end. These can be hard to find sometimes. This brings us to the next one, the transaction costs. Transaction costs are incurred when a mutual fund trades shares of an underlying stock, and as a group, these transaction costs include brokerage fees, market impact costs, spread costs, and soft dollar costs. These expenses are almost impossible for an investor to see, but they do impact the fund's performance. Brokerage fees or commissions are the fees a fund must pay to its brokers for executing the trades. There are also commissions for each fund that can be found in the Statement of Additional Information, the SAI, usually in the Portfolio Transaction section. However, current regulations do not require the SAI to be distributed to investors, so you really don't know what it is unless you ask for it. Market impact cost. This stems from the losses per trade when a fund buys or sells a large number of shares in a particular stock, meaning if a fund sells a lot of stocks, it will negatively impact the price, thus lowering the price and impacting the stock. For example, when a fund buys 1 million shares of company XYZ, the sheer size of this purchase can cause the price paid for those shares to rise during the transaction, This increases the cost and ruins the basis of the position. The spread cost. The spread is the difference between the price at which the fund buys a stock and its cost to resell those shares. Spread costs can also be referred to as a liquidity cost, or the less liquid shares are of a particular stock being sold by a fund, the higher the cost is to find a buyer. On top of the spread costs, mutual funds incur something called frictional costs. When trading, this is like employee time, administrative effort, technology cost, etc. All of these resulting in more cost for you as an investor. In turn, the higher the annual turnover rate of a fund, the greater those costs. Higher commissions, higher market impact, spread costs. So look at the turnover too. Soft dollar cost. A mutual fund will often pay a broker high trading fees in exchange for the broker's research. That premium boosts the brokerage commissions that the investors pay. Such costs are very difficult to determine. Soft dollar costs are yet another example of the hidden costs that drag down the fund performance, so you will see it in the performance of the fund. Cash drag cost. Cash drag refers to the earnings lost while investors' money are sitting on the sidelines, so the greater amount of cash in a portfolio, the less the fund earns in rising market. This is not to say that cash in a portfolio is a bad thing, as long as a fund manager is searching and holding out for a more attractive stock to put the money into. But it rarely happens. Tax cost. Taxes erode mutual fund performance over time. That's a given. If possible, you should invest in funds through a tax mitigating product that allows your funds to grow while minimizing taxes. Advisor fees. Advisor fees also impact on investors' portfolios. If advisors charge a large fee for their services, total returns will again decrease. When I started to look into different mutual funds, I found that many investors actually pay 3 to 5 times the published expense ratio. The average expense ratio in the funds I looked at was around 0.8, yet most total annual expenses were around 3.2 or 4.3. However, transaction costs are not reflected in the widely published expense ratio for nearly all mutual funds. In order to estimate mutual fund total expenses, you have to add up all these categories I mentioned before. Before I get into how you can avoid all these fees and expenses, I would really appreciate you hitting the like button and maybe even subscribe. How can investors avoid these high and sometimes hidden fees associated with funds? Well, I already hinted it in the calculations. Look for the low-cost ETFs. Look for the turnover to be as low as possible. These exchange-traded funds, ETFs, are a good alternative for most investors, and they provide much better cost structure than a mutual fund. And actually, they usually also outperform them. But pay special attention to the expenses in the prospectus. ETFs are also more tax efficient than mutual funds. When ETFs sell securities, there's no taxable event because ETFs are able to redeem shares for baskets of their underlying securities in a process known as in-kind redemption. Additionally, mutual funds must purchase securities when investors bring money to the fund and sell them when investors leave. ETFs are better able to minimize those transaction costs. ETFs are also far more transparent, disclosing their holdings daily, while a mutual fund only tips their hands semi-annually and 60 days after the fact. Furthermore, ETFs offer real-time pricing information. Mutual funds are priced just once a day after the market has closed. ETFs are often specialized, which can be a great help to investors looking to ensure a diversified portfolio with minimal overlap. For these reasons, an ETF is almost always the better choice over a similar purpose mutual fund, and especially if you use Vanguard's low-cost ETFs. That said, there are a few active managed funds that actually outperform the market, but they are very few and very far apart. And the reason they outperform is usually because they're picking single stocks, and with that strategy, you can benefit anyone. My advice is, use low-cost ETFs and build your portfolio using these as a base. Maybe you then can supercharge your portfolio with a few single stocks you have researched and have high conviction in. I'm still playing around to find the perfect portfolio, and the current ETF mix I'm looking at would have yielded around 10 to 12% compound annual growth over the last 20 years. It could be more aggressive, but this one is fairly diversified too, so I avoid risk over time. If I were to supercharge the portfolio, I could use a single stock, like for instance Microsoft, and put Microsoft in 10% of the portfolio. With Microsoft, it would be at least 12% compound annual growth, and so on. You get the picture. A fairly safe and diversified portfolio with returns above the S&P 500, and if it was supercharged with a great single stock, it would become epic. Just to show you how much, let's say again we take an example. We start with $10,000, put in $400 every month, and do this for around 20 years. With a portfolio with an ETF mix and let's say Microsoft in it, we would have had almost 24% compound annual growth. And in 20 years, that portfolio would have grown into $550,000. Wow! That's beating the S&P with almost $176,000. I would urge you to find your own risk profile and find the ETF mix that you find the best and see how that portfolio could have performed and try to figure out which asset class you believe will grow the most in the next 20 years. Well, I hope you got some value from this video, and if you did, please hit the like button, maybe even subscribe. So that's all folks, hope to see you in the next video. Remember, the best investment you can make is in you. The more you learn, the more you earn. Bye!
I have a dream, that's all I need. I'll make it happen with some work and belief. Know what I want, so I'll take it on. I've made mistakes, but mistakes make you strong. Let's break it down for a minute. I want the crown, I'm gon' get it. You hear me loud, man, I'm winning. Yeah, Charlie Sheen will be grinning. These ladies know that I'm sinning, and this is just the beginning. I'm closing in the ninth inning. There ain't no point in resisting. Living